Hello, everybody, and welcome to another episode of the Cross Country Super Podcast. And as usual, I'm joined by my co-host, Gemma Sanderson from Cooper Partners, all the way in from Perth. Hi,
Hi
Gemma,
Darren,
how
how's
are
it
you?
going?
It's great to see you as usual.
Yes, you too, and I'm ready to chat all things nerdy and super. So exciting.
Yep, another hour of nerding it up, as you like to say,
Yep,
Gemma. And
totally.
who doesn't
Yep,
like to nerd it up? Absolutely, we do.
yeah,
So
absolutely correct.
today we're actually going to talk about a recent court case appeal that has multiple layers of SMSF implications in it. In fact, if you had to pick one court case and tribunal appeal, it would probably be this one to cover such a wide range of SMSF issues. And as you can probably tell, there's a lot to unpack. So we're actually going to do it over two episodes because it's just way too much information to get through in one episode. And of course, Gemma and I realize our downfalls of
Chatting too much.
constantly going off
Yeah,
piste, as we like to
yeah,
refer it.
yeah.
So we're not going to try and shoot the lights out. We're going to, as Harry Callahan would say, realize our limitations, and stick to just two of the subjects. There are mainly four identified subjects, but we're going to stick to two of the subjects that were highlighted. So the case we're referring to is Merchant versus the Commissioner of Taxation. And Gemma, where would you like to start? Do you want to take us through sort of the basic plot lines of
Yeah.
what happened to bring this all about?
Yeah, okay. So, a really interesting case with, like you said, quite a few issues to unpack. And so, again, as our proclivities are to talk a bit too much, then it does make sense for us to tackle two of them today and the other two in a subsequent podcast. So, this is one where most Australians would be aware of Billabong, which is an iconic surfwear brand, and Gordon Merchant was one of the founders of it. So it's all about him and a transaction that occurred between his superannuation fund and his family trust back in September 2014. So there was a lot in the lead up to that. And it's interesting when you reflect and have a look at the timing of some of these transactions. So there is a bit of background and history to be aware of. But I mean, I can't remember what I did yesterday, let alone, 10 years prior when those sorts of transactions are being put into question. So it's one of the key learnings. So start at the end and work our way backwards. One of the key learnings in all of this is documentation, and one of my favorite words is contemporaneous. So that good old at the same time, contemporaneous documents of the transactions when they've occurred, rather than going, oh yeah, well, we did that for that reason. Of course, that's why we did it. So, well, you haven't justified that in any way, shape, or form. Anyway, let's get started and just go through a little bit of background. I probably will gloss over some of the bits and pieces in here. If anyone does want to nerd it up, there's a couple of great judgments that you can read. The AAT decision was to do with the superannuation fund and the transactions happening there and the super compliance issues. And there's also a federal court judgment regarding the tax issues in the family trust itself. And that considers Part 4A as well as various other bits and pieces. And my understanding at present is that that has been appealed. So we await the outcome of that to see how that sort of flows through. And to date, basically the loss that was realised in the family trust has been disallowed by the tax office and confirmed in the federal court as the outcome. Anyway, let's go back. So this is a self-managed fund, and it was set up in 2009 where Mr. Merchant was the member. And another person that is relevant in the scheme of all of this is his assistant slash colleague slash close friend, Colette, who also was a second director at various points in time with respect to the corporate trustee of the fund, and also held a power of attorney for Mr. Merchant along the way. Now, at the time that all these proceedings happened, she had passed, so she wasn't able to be a witness or anything like that, but she certainly had signed off on documents along the way on behalf of Mr. Merchant. And so even some of the things that she was signing off on was, you could consider to be a little bit contentious in terms of the Corporations Act. And could she have signed in her capacity as a director of that company, and then in her capacity as a power of attorney on behalf of Gordon when he was still a director of the company. So, that's a whole other thing to consider. And maybe people can listen to the podcast we did on Gainer, where we were talking about trusteeship and those sorts of things. So anyway, fund set up in 2009. Gordon was one of the founders of Billabong back in 1973, and it was a bit of a stock market darling when it listed back in the day as well. But it had some performance issues, and throughout this whole period, it continued to be a listed company, and however, the share price definitely declined over the period of time. So there was a property in the fund at the get-go, as well as some other assets in there, but quite a substantial amount of cash in 2009, and an investment strategy was put in place. But so that's sort of just the genesis of that. Then a few other transactions happened in subsequent years, namely 2012. So by then, the shares, a lot of the shares in Billabong had gone down in value from that perspective. And the super fund acquired some shares in Billabong at that time in 2012. So that was the first tranche that happened. And an investment strategy was put in place in 2012, which there's some minutes of a meeting that says that both Gordon and Colette were there. She has been the only one that has signed them. If they were minutes of the meeting, she was the chairperson, and where they considered what the investment strategy for the fund was. And at that time, even the property allocation was out of range from that perspective. So 2012 was when the investment strategy was put in place. In 2014, there was a rights issue for more Billabong shares, which the super fund took up, as well as within the family group, the trust. And then it was in late 2014 calendar year, so it was September 2014, that $5.8 million worth of shares in Billabong were purchased by the fund from the family trust, rather. And that's really the transaction that is contentious at this point in time. Now, when that all happened, the advice that had been provided by Mr. Merchant's advisors was from the perspective of the family trust. So the family trust owned some shares in another business, and that business was about to be sold, and a substantial capital gain realised. So the thought was, on the basis that Mr. Merchant wanted to keep his overall share holding in Billabong across all his entities, but within the family trust, there was a substantial unrealised loss. So the whole thought was, well, the super fund's got quite a bit of cash in it. Why don't we sell these listed shares to the super fund at market value? That will crystallise a loss in the family trust, and therefore that will be of benefit when these other shares get sold. So that was the advice that was provided, along with other bits and pieces to do with the family trust side of things, and effectively this other business. And then the tax office didn't like it. And so that happened, like I said, September 2014. And it was 2020 when the tax office sort of put their hand up and said, we don't really like this transaction. We want to have a look at it in a bit more detail. And things progressed from there. So again, even when you think between 2020 and 2014, that's a long period of time. And if documentation wasn't put in place that sort of justified why the transaction happened, so this is where you got to wear your different hats. So he was obviously in charge or in control of the family trust, but also the super fund. But you've got to wear the different hats. It can't just be, well, for the family trust perspective, let's move this. Well, hang on. Is it a good investment? And is it appropriate for us to undertake that transaction from the super fund's perspective?
Yeah, I mean, and it's an interesting one from the get-go. You mentioned, was it Colette?
Mm,
Seemed to be
yeah.
doing a lot of the actions on behalf of Gordon Merchant.
Yes.
And some of the facts of the case came out that she signed some of these documents, which I don't know whether or not he actually admitted this, but it would appear he didn't even cite them.
Yes. Yep.
So
That
so let
sounds right.
alone let alone having to actually be a part of the process of putting the document together and signing off on it.
Mm.
It came out that for some of the things he didn't even cite the documents.
Or he
So
hadn't even recalled the
yeah,
conversation
yeah,
about the
or he couldn't
document either.
remember it,
Yeah.
and that's obviously the time period that's elapsed. That is a realistic possibility. But as Gemma says, it just highlights the fact that, and it may seem inconsequential at the time, and you know, unnecessary and boring administrative procedure. But look, you can't foresee something like this will happen down the track. And if you don't have that audit trail, then how do you prosecute your case to defend um, an action that's unfavourable to you, that maybe the ATO imposes upon you?
Yep.
And
That's right.
there's no coming back from that. If you don't have the evidence there, then they're not just going to take your word for it. As much as you could be telling the truth, I'm not suggesting that people don't tell the truth in these situations, but they're not just going to take your word for it. They can't. It's not a standard that they would uphold, and so that is really important, and it's kind of in a way hard to see how could you be so lax that you couldn't, like, there seemed to be a complete disconnect, didn't there,
Yeah, definitely.
between abrogating or delegating responsibility to somebody else, but then having absolutely no involvement or no responsibility over the action yourself. Like, they're two different things. Of course, delegating is one thing, but it doesn't absolve you of any responsibility at all in these types of circumstances. And of course, when do you find out? When it's too late
When it's too late. Yep.
and the proverbial is hitting the fan.
And also the other thing, hit the arguments that were made regarding, so this was a big investment strategy issue that came through. And one of the, there was various arguments that were put forward. And one of them was, well, I was looking at everything overall, and I had a view on Billabong, and I thought that it was unjustified, over an overcorrection of the market with respect to it, and I thought it was going to come good, and all of these sorts of things. So that's what he said. But then there's no documentation of that. So that would have been of assistance at that time, no doubt, to sort of say, okay, well, yes, I'm acquiring $5.8 million worth of shares from the family trust. And that transaction, when you just have the lens of one of the SIS provisions, which is Section 66, the general prohibition against the acquisition of assets from a related party. But there is that exception, which is listed shares. So you'd think, oh, yep, as long as they're done at market value, bang, that's fine. But then you've got to overlay some of these other considerations. And one of the biggest ones, and one of the big issues that was looked at was the investment strategy, and the fact that there appeared to be one in place, and it was not reviewed, it was not considered, so that you've got that standing document there that all investment decisions of the fund should refer back to, and that investment decision should be made on the basis of that review of that investment strategy, and that there was zero evidence to support that had happened,
Yeah.
and that was one of the big issues.
It was patently obvious because, going right back to what you said, Gemma, obviously the contentious issue revolves around the transaction of the share purchase here. But one of the things that was actually brought up was not to do with this transaction at all. It was the
Mm.
fact that the super fund owned a property, and yet the investment strategy did not allow for the super fund to own a property. Like, it
Or own
didn't, it
any
didn't take
property. It
Yeah.
said
So
0%. Yeah.
it didn't take any of that into account. As you said, it's 0% as far as a property allocation goes. But there it was. There was one sitting in the fund. So apart from reviewing, I would actually argue, did anybody actually look at it?
Yeah.
And again, to your point, every decision has to be done via the prism of the investment strategy. You have
Yep.
to go through it, otherwise you will come unstuck from a compliance perspective.
And particularly here when you're dealing with a related party. So it's really important that you've got that extra layer of consideration from that perspective. And when you look at, I mean, the tax office had their wash sales, I think it was an ATOID or a tax ruling or a taxpayer alert, where they had real concerns about the situations where people might, they've no loss of the risk of the asset, but they've just moved it from one entity to another to crystallize that loss. And so, you know, those CGT wash sale provisions, which was one of the elements of the Part 4A that went through the federal court. So there was that consideration in there. The other thing that also didn't help with respect to the investment strategy and the fact that it wasn't really looked at or reviewed was that over the period of time Mr. Merchant was in pension phase. So he had commenced a pension with his entire benefit. And over a period, he had taken out your $450,000 minimum pension. That reasonably consistently, obviously, with, you know, you're looking at the minimum pay. So his original fund was worth about 17 million. And then that went down quite substantially. So the 450, those amounts would have been a minimum based on whatever amount he happened to have in his pension. Obviously, this was pre transfer balance cap. So that's what that looked like. Not long after these shares were purchased by the fund from the family trust, the fund had some cash flow issues in paying out his pension. So they ceased his pension. And again, that really highlighted the fact that in the acquisition of those shares, that investment strategy wasn't considered or reviewed from that perspective, because you know, we go through the nerdy legislation here. So the investment strategy side of things is in SIS Regulation 4.09, and the requirements in that is that you've got to consider the risk, diversification, ability for the fund to meet its liabilities, and insurances. They're the sort of main ones. I think I've lumped two of those into one of those things I just mentioned. So there was no consideration of the liabilities of the fund being, well, he's in pension phase. So how are we going to satisfy that from a cash flow perspective? And, you know, there's a contract between the fund and Mr. Merchant for those pension payments. So that's a consideration for the trustee. Again, which hat are you wearing? You've got to wear your hat as the trustee and say, right, well, we've got this obligation. We're going to have to consider how that's going to be met. And that happened not long after. I think it was by 1 July 2015, that pension had ceased because of that. Now, again, Billabong was a share that very, very rarely, if at all, paid a dividend. So you can see that there would be cash flow issues from that perspective.
Yeah, that's a great point to highlight as well, Gemma, because again, on the surface, it might appear that, well, who cares? He stopped paying a pension. He commuted a pension. That's his prerogative to do if it's not suitable. But it's amazing how all of these dots are joined together
Mm,
by the ATO when they're prosecuting a case like this to provide it with more evidence that, well, actually, you didn't actually think this through. And while you might argue that, well, that's effective liquidity management because I can't support the pension anymore, so I'm doing something about it, so I'll commute it. The fact of the matter is it's the transaction that you went into that's caused that problem,
yeah.
which the ATO is seeing as, well, you didn't think that one through properly, did you? And I I might be wrong on this one, but was there also an issue with the investment strategy because that transaction put them outside the bounds of the allocation to equities that they could actually make inside the
Yes.
SMSF?
Yep.
I think it pushed them over that limit, which again demonstrated that, Well, did you have a look at the investment strategy as to
At
what
all.
you can and can't do?
Yeah.
Because, and I mean, that's not asking the trustee to go into nth degree depth of, I didn't realize, that the 10th tier of implication was going to be triggered because when I did this, I didn't think that far in advance. Simply observing the percentages or the allowable allocations within a portfolio is pretty basic stuff, I would think. And there's really no coming back from that. If it says 30% and you've got 60% to equities, there's no argument there, is there?
Well, and this is the consideration, and probably highlights the challenge and why auditor independence has is really important, because I'm surprised the auditor didn't pick this up every year and say, hang on, you're out of range with your investment strategy. The other thing with all of this, so there's a couple of elements, I mean, again, lots to unpack in this one, so firstly, it's not the tax officer's role to determine or make a call on how someone decides to invest their SMSF, as long as they do it within the realms of the SIS legislation. And part of that is, well, the realms of the SIS legislation is making sure you have at least considered all these bits and pieces. Now, there's nothing in the SIS legislation that requires the investment strategy to be written, but then it's pretty challenging to review that strategy and check to make sure that you're making decisions based on that strategy if it isn't written down. So it's just one of those things where every auditor will ask for a copy of it and check it out from that perspective. Also, it's not set in stone, and this is the other thing. If you want to invest in something like and increase your holdings to listed shares, fine, you can, but then you would need to look to amend the investment strategy and the reasons like that why you might be pulling your ranges out or whatever, like expanding them out. And then still the justification for the acquisition of those new shares would need to flow through from that as well. So it goes hand in hand. And rather than, again, what's highlighted here, rather than going, oh, yep, we'll just backfill that later, figure out what those documents need to look like. It's like, well, no, hang on. We've got to, what's the time frame? How should we be putting in place those documents to make sure that, again, it's all beyond reproach? It's contemporaneous, if not preemptive, so that, again, when you've alluded to, and I said, I don't remember what I did yesterday. And so sometimes once a transaction happens, you're like, yep, that's done, and off, and you move on. And you forget that you might need to then make sure that everything is lined up. So it's one of those things where you're better off getting all the ducks in a row and before you undertake the transaction.
Yeah, I think you raise a really good point there, Gemma. I would struggle to think that any auditor worth a pinch of salt would not have picked some of these issues up if it was happening today, only because there is so much onus now placed on SMSF auditors to try and monitor some of this stuff. And I mean, pretty basic. Even if you don't want to talk about percentages, the fact that you can't hold a property.
Mm.
I mean that's pretty straightforward. Hang on, Gordon, you've got a
You've got a
property
property in there, but
in
your strategy says
SMSF,
zero.
but your
Yeah.
strategy says zero. I mean, that's not asking you for, some of the more intricate, what's the valuation? I can't get this, which is a lot of the debate that we have around auditing issues. This is pretty straightforward stuff.
Mm.
But I would severely doubt in today's world whether or not you could possibly get away with that. That an
Oh, it would have
auditor,
been picked up straight away by
yeah,
a new, like
100%.
and this is this independence consideration, because the firm that did the financials was also the auditor. Again, that's my understanding, because the reference to the auditor and the fund accountant are used almost interchangeably when you review and have a look at the decision. So that's the consideration there, that someone, I don't know, didn't rubber stamp it, but perhaps didn't give it that level of scrutiny. And that's one of the reasons why the auditor independence is a really important change that's happened in recent times, I think, in my opinion. And I mean, we're not getting into it now. We encounter a lot of times where many issues in super funds could have been picked up much sooner if you had that independent person reviewing the financials, as opposed to the situation where audits were done in-house, and then we're having to fix issues that could have been dealt with years ago, or at the time there was a breach, like straight away you could have dealt with it, rather than we pick it up 5 years later and are like, oh, there's an issue here, etc., etc. So yeah.
Yeah, we've gone off piece a little bit,
As we always do.
again, it is a great point to raise as far as the auditing process goes, because it's not only a matter of the independence thing particularly, and of course that's being stamped out now that you can't do the accounts and do the audit as well. But it's also, auditor independence also involves having a client for a long time, and maybe there's some undue influence.
Yep.
You know, if if a person's been auditing Gordon's fund for like the last 20 years, you know, he might say that, oh, Gordon, you might have a bit of an issue here. And Gordon would say, oh, don't worry about it. You know, I'll sort that out later. Okay, I know you. It's all right. I'll sign off on that. Well, that is actually perceived as not being independent, because the relationship between the client and the practitioner is too close.
Yep. 100%. Yep.
In which case it's obviously influencing professional judgment, which is what they're trying to stamp out.
And so the consideration in this merchant case from that investment strategy perspective is very much documentation, review, and then making sure that those investment decisions that happen on an ongoing basis, you're referring back to the investment strategy, and you've got contemporaneous justification or reasoning behind a particular investment decision. Now, I feel like that's not going to be, I buy, 10 shares in BHP and all those sorts of things. But at the same time, usually if you've got an investment advisor involved, they've got the investment strategy which they have often, well, more often than not, they've had input into what that needs to look like, because they've done the risk profiling for the fund and the trustees, etc. So they're heavily involved in that, and all of their recommendations are done in line with that. And there would be documentation to support that. So you've really got that along the way there. It probably would come down to the consideration where it is a pure self-managed scenario. So someone did the pro forma investment strategy. Oh, yep, that'll do. Slapped it together, sent it, has got it on a file, and then they don't even look at it again from that perspective. And they go off and they've been happy to undertake transactions here, there, and everywhere, but then have those investments been made in line with that strategy?
Yeah, really important. So again, practically, you have to document all of this stuff to make sure you don't fall foul of the rules. And I'm going to throw it in now, Gemma. It's not like you can use the old Jedi mind trick where
Yeah.
you can tell the ATO, these are not the investments that you're
These are
looking
not the
for.
droids you're looking for.
This is not the transaction you need to scrutinize. Move along, please.
Yeah.
You
Move
can't do that.
along.
You
Move
can't do that.
along. No, you absolutely can't.
No.
So yeah, very but again, it just highlights the self-managed super funds have got a high level of compliance around them because of the tax concessions. And this is one of the areas where it's easy to make sure you're covering off on everything along the way, so that is just not even a consideration in the piece. And just the importance of documenting that strategy, making sure it's reviewed, and yeah, and I feel like it's a straightforward vanilla item when in the ongoing management of a self-managed fund.
Well, it should be, but
Should be,
doesn't
yes.
always play out that way, as we know.
Yeah,
Now,
that's right.
do you want to move on to the next issue, which
Next
is
issue,
sole
yes.
purpose test? And again, this is one of the things that Gemma has highlighted, that you have to recognize which hat you're wearing if you're talking about especially interspersed family entities,
Yep.
because it's very easy to get confused and caught up in people, and this is a good case of the macro picture being looked at
Yep.
without the actual individual components of how it all fits together being given any consideration at all. It was all just about the macro picture. What's the
Yep.
macro outcome on several levels, not just one, that we can get to if we put this transaction through? But as we know, unless you look at it through the absolute lens of the SMSS, when we're talking about SMSF compliance, ain't going to fly.
It ain't going to fly. And that's the thing. And this sole purpose test is, it's almost like an overarching integrity measure, catch-all, to be able to say, okay, well, yeah, you ticked 66 because it's a transaction between related parties, and it was done at market value. So you've gone through that element. Say you had considered your investment strategy. Yep, it was in line with the investment strategy, or that was perhaps updated so that it would accord with that. Other bits and pieces that might fall into that. But then there's this overarching sole purpose test. So sole purpose test is in the SIS Act under Section 62, and it goes through core purposes and ancillary purposes of running a self-managed fund. And the core purposes are for the retirement of members and death of a member, so to provide for their beneficiaries, or the disablement of a member, or to provide for their beneficiaries. So they're the main ones. The ancillary ones are a bit of an extension of those, realistically. So a lot of those considerations are looking at, right, well, if you were to just wear your trustee hat and you were going to pay $5.8 million for some shares in a company. So there's an element of a diversification consideration there. Is that really going to provide for the retirement of the member? Now, back to the consideration with the pension payments and the liquidity. So there's almost an interaction here between the investment strategy and the sole purpose test as well. So we've got cash flow considerations because we are providing an income stream for the retirement of the member. So if we can't do that anymore because of the nature of this investment, then again, the sole purpose test is a big consideration there. Now, a lot of the time, the other thing with the sole purpose test is that the super fund is providing a current day benefit to members when it needs to be used to provide for the retirement of members. So that was, again, another consideration because, and this dovetails into the third thing that was tested, but we're not going to talk about that too much today. And because they all interact. So with that sole purpose test, by the fund buying these shares from the family trust, then there was a current day benefit provided to the family trust and to the family external to super in the form of this capital loss. Because they crystallised a loss that enabled a gain to offset and reduce a crystallised capital gain. So that was really a current day benefit that was provided to the family trust. And so the super fund, its purpose for undertaking that transaction, that was the core purpose. It wasn't to provide for the retirement of the members. Now, Mr. Merchant came out similarly to looking at the investment strategy, saying, well, I had confidence that Billabong was going to turn a corner and come good. I wanted to make sure that the market saw that I had that confidence in there, which again, that sort of is more, like you said, that macro consideration of from that perspective, not, well, then, okay, great, if you want to show that confidence, but should you be using the super funds asset to do that, to buy those shares, and knowing that then there might be some cash flow issues and all of those sorts of things coming through. So that was really one of the big considerations with respect to that.
Yeah, it's really important. It's almost the simple question of, as the SMSF trustee, ask yourself why you did it.
Yeah.
And in this case, as you said, and Gordon Merchant was upfront about it, even though it probably didn't help his cause.
No.
But when you're talking about, oh, I wanted to, boost the confidence of other shareholders that, the company's still a good going concern. I've got every faith in its operation, and it's going to turn the corner and whatever. Well, right there and then you've destroyed the sole purpose because, okay, so how is that about your retirement?
Yeah, that's right.
That's absolutely got nothing to do with your retirement. It may be a justification for why you did it in your mind.
Mm,
But by actually admitting that, you've actually admitted that you've breached the sole purpose test. Ironically, because he's probably putting that forward as a justifiable defense for what they did. Also, it was pretty clear from the evidence that it was all done to neutralize that capital gain for the family trust.
or help
Um,
reduce it. Yeah,
so, so,
100%.
so,
Yep.
so, so there's another thing. So that if you argue that, then the transaction's actually done for the benefit of the family trust, not for the benefit of the
Of the
self-managed super,
fund. Yeah.
which
And for members, for the members of the fund. So has the trustee actually breached its duties to the members of the fund because it acquired an asset that then would have cash flow issues and things like that. And it's
yeah,
interesting that so there had been sort of three transactions with respect to Billabong and the fund. And so there was an acquisition of shares in 2012, then a rights issue in the 2014 financial year, and then this happened in the 2015 financial year. And some of the justification for the other transactions were to retain a substantial shareholding in Billabong, to provide that market confidence and certainty. So again, even those transactions that happened, like were they justified in the context of the sole purpose test as well?
well, and of course they're not because uh, you're almost admitting that you're using the super fund to as a vehicle and a means to another end. I mean,
Yeah.
just because you purchased the shares in the super fund and it may result in this, but it can't be for I did it because I want to retain the family shareholding in the company as well.
Mm,
But
yeah.
that's neither here nor there. That's got nothing to do with the price of fish.
Mm,
That might be good, and it might be a good sort of tangent that I've looked after my own retirement, and as luck would have it, I've managed to keep the shareholding within my family, which is important. But
mm,
that's got to work in conjunction with each other. It can't just be, oh yeah, and just use the super fund to hold these shares so that we can continue to obviously have the majority shareholding of the entity within the family unit. Again, that's not going to wash because it's pretty specific. The sole purpose test is about your retirement. How is
mm,
that goal linked to your retirement?
yeah.
I mean, even I think the most clever lawyer couldn't even prosecute a case for that. And in some ways, it reminds me a little bit of the contentious issue around the benefits you might get from a particular shareholding. So I'm talking about the Coles Myer
The
gift
discount,
card,
yeah,
yeah,
the Myer discount
the
card.
Coles
I
Myer
remember
gift
those.
card, right? So if you bought the shares basically, um, originally because you like Coles Myer and it was a good thing and the shares were going up, and it just so happened that you got the gift card as part of your shareholding, no problem. Because again, why did I do it? Because I like Coles Myer. I think retail is going to go up and it's fantastic. I just so happened to get this discount card, which is good, but it wasn't why I did it. But if you turn that argument around and say that, oh, I got it because I wanted that gift card, and I was also able to add some shares to my self-managed super fund, well, as silly and as basic as that sounds, that constitutes a breach of the sole purpose test.
Yeah.
And it's a little
That
bit,
was a really interesting one. I remember at the time that going through that analysis was because most people did use their super to invest in Coles Myer to get the card. They were like, well, why am I paying? I can get a 5% discount at the supermarket by having a minimum number of shares. And it wasn't even that many shares that you needed. Well, I don't have the money to buy them personally. I'll just put them in my super fund and I'll get the card. And it was Wasn't even a very difficult decision, but yeah, they're a very interesting and like application of the sole purpose test from that perspective, and that sort of led to that whole thing of, well, if it's a byproduct that everyone gets and it's not an option that you've selected when you could opt out, then it's fine. As long as it's, insignificant in the scheme of it all. But if that's because then they had the different classes of shares for the discount card
Yes.
and not, and people just came a cropper from that perspective as well. So anyway, again, a really interesting when you consider the application of the rules, the sole purpose test to those sorts of transactions.
So getting back to this case, they didn't really do anything to disguise the fact that the transaction was for tax purposes of
Yeah,
the family trust. They didn't really, I mean, Gordon Merchant, to his credit, does not seem to have been devious in any way of trying to defend what he did. He's pretty much been upfront about, well, this is why the transaction went through. Unfortunately, it's
that didn't
kind of
help him.
scuppered his case because it's all
Yeah,
counted against him.
yeah. But the other thing with that is he was relying on advice. So when we talk about the disqualification next time, that was a real consideration. So he, as they were looking at the sale of these other shares in the family trust, and his advisors were considering his tax position, and they are the ones that recommended, well, you've got an unrealized loss there. Why don't we sell the shares? And then you would crystallize that loss. But then because there was no real change of economic benefit, one of the considerations or the terminology, because those shares just moved within the family group. You've got that wash sale, and then there's cash sitting in the fund. Well, instead of selling them on the market, let's keep the market confidence in it, and let's use the cash to do that. So really, the purpose of the sale of the Billabong shares was to get this loss, and then the super fund just was the the way that they could accomplish that without losing their shareholding in it. So the consideration was, well, really the predominant purpose of that transaction was to get the loss, and really there was no even thought to whether that was appropriate from us, the super fund, and providing retirement benefits for the members.
Yeah, it's an interesting one, and again, so many tentacles
Yeah,
from this case into the broader sort of SMSF landscape. But there have been instances where the argument of, well, if I didn't do this via the self-managed super fund, potentially that entity might fall over. Now, I'm not
yep,
suggesting for a minute that Billabong was going to fall over here, but the premise is kind of like the same, isn't it? Whereby, I wanted to purchase those shares in the super fund because I wanted to give an indication that this is still a robust entity and whatever. Well, again, I'm not suggesting that Billabong was ever going to go bust, but obviously the share price had taken a pretty significant dip, and that gets people worried. It
yep,
always does,
yep.
from a going concern perspective. So, what's to say your transaction didn't prop up prop up the company that maybe was heading south and there was no future for it? Now, I'm
Well,
not
that's,
suggesting that
yeah,
that was going to be the case, but you could
no,
make an argument for the fact that, well, actually, mate, what's to say you're not actually, I don't know whether or not that goes towards lending financial assistance or whatever, but you could argue the case that, oh, all right, well, the share price is heading in this direction. With that transaction, are you not propping up an entity that could be in the midst of showing indications that it might be going under?
yeah, well,
You know?
I mean, I don't know. I'm not an investment person, so which is often a benefit. And when you look at these sorts of things and you reflect back on it, and I guess with the benefit of hindsight, you could well say, well, as a result of, so did it prop up the company artificially? And but then what happened subsequently? And so in this particular case, it again, because it's a publicly listed company, the market tells you sort of what the price is, but then, that other consideration, all this is like you said, was it maintaining that market certainty and therefore keeping the price up? The other thing that came through, which was, back in the 2012 transaction and the rights issue in 2014, was to maintain a substantial shareholding to stop others from having a controlling interest. So all of those other like those considerations as well. It's not the fund by itself looking at the best thing for its members. It's that wider consideration. And back to, what was the purpose of the transaction? Well, I was advised that if I did this, I'm going to get this wicked loss that I'm going to be able to use to offset against a future capital gain. So of course I'm going to take that advice. I never expected that in the consideration that was the tax advice on the family trust side, that the super fund side wasn't, contemporaneously considered, because obviously it's the same advisors in each camp. So they should have been wearing their own hats as the advisors of each entity with that lens as well. So it's again, highlights. And then this is a challenge, because someone like Gordon, he had been, he was the founder of Billabong. He was probably a proper surfy dude back in the 70s and had built this brand. And so tax and superannuation, that's why that got outsourced to his, the professionals in that area. So you're not going to go to, I don't know, the local, you're not going to come and ask me how to learn how to surf, are you? But you'll come to me to discuss self-managed super fund stuff. So, that whole consideration, he relied a lot on his advisors and got a bit of a bum steer from that perspective. Without that, it would appear without the comprehensive consideration of how it impacted each entity from that perspective.
So we've talked about what sort of mistakes that Gordon may have fallen into, but what about from the advisor's perspective? As in, Gemma, how difficult is it for them to delineate? Because obviously, again, if you're going to an advisor, he's seeing all of these different pieces of the puzzle, and then he's seeing that, okay, well, I can get you the best outcome by doing this, by putting together this transaction. But how does he or she delineate between, oh yeah, but if I look at it from the super fund perspective, it's probably not a good idea to do that. I mean, how do they unpeel those layers and kind of stay true to, well, he's my client and I want to get the best tax outcome for him, but I don't want to get him into any sort of compliance issues with his self-managed super fund either. So how does the advisor balance that? Because obviously the throwback would be, but Gemma, like that on the surface level, you asked me to do the transaction because it will offset the CGT implications of the share sale that I'm about to have to do in my family trust. But now you've looked through the SMSF lens and you're telling me that, oh no, actually you shouldn't do it. Aren't you, as my advisor, supposed to be getting the best outcome for me? Like,
Yeah.
I'm a bit confused here. Which direction am I supposed to go in? Like, how does the advisor actually manage that process? Because obviously, between the two pieces of the puzzle, there's conflicting parts.
And I think that this is again highlighted, this case highlights all of that, because, or, what that role is. So, and a lot of the time, the clients have got multiple entities that all interact. And so and we've got, tax practitioner board obligations, honesty and integrity, competence, all of those sorts of things, that ongoing continuing professional development required by all of the professional bodies to be on top of these sorts of things. So you can't have your blinkers on and be looking, well, what's best for here is this, without the consideration of the other entities. And maybe the advisor is, okay, well, I'm the tax guy, and so I know this, but hang on, if the super fund is buying it, I need to get the super people involved. Now, they could all be one and the same, And so the consideration with that could have been, okay, well, Gordon, we think that there's an opportunity for you to do this, but these are the risks. So highlighting, so from within the trust, there's an ATO ID or a taxpayer alert that talks about wash sales. So you're taking a risk on that front. There's also superannuation provisions that deal with we need to look at the investment strategy and make sure that we're according with that, justifying the decision from an investment perspective. So it's really just it's going through the process and advising the client accordingly on what. So sure, there's a strategy there to look at, but what's the risk of it being considered Part 4A on the trust level by the tax office, issues with the super fund compliance? That's again the lens that we need to have a look at here. And when you look at just the straight transaction, moving shares from the trust to the fund, you'd think, oh, yeah, 66, yeah, you're fine. But there's just more that needs to be unpacked from that perspective. And this is where getting the right advice is important as well. So some people, they might not, they might be all over the tax side of things, but the super element is just, it's a bit contentious. It's not a paddling pool that they play in all the time. So that's perhaps where they need to go and get, if they're advising a client, go and get that advice to make sure that they're not falling foul of those sorts of areas. And this is where this sort of case does help the industry because it highlights those areas that the practitioners need to be on top of because I don't want to talk about licensing and all those sorts of things, because if you're providing that advice on everything and you haven't considered that and advised of the risks, then you've got, well, is there an AFSL? You're providing superannuation advice, so are you covered under an AFSL? And also, if you are providing that advice, how does your professional indemnity insurer consider that coming through? And what are the requirements for you to have provided that advice? So that's that whole the ethical standards and the requirements under being a registered tax agent, being a member of any of the professional bodies, as well as the financial services provisions. So there, again, there's quite a bit to unpack in there. But most of the time, what you would like if you're backside covering, I guess, as an advisor and making sure you've got good file notes saying, look, I spoke to Gordon, I spoke to Darren, and we were looking at undertaking this transaction. Here are the risk factors involved from the trust perspective, the tax perspective, in both the super perspective. And we advise, our advice is to do it this way rather than that way because of these reasons. And then maybe an instruction back would be, no, I want to go with that option that's got the higher risk because I'm willing to bear the risk. So it's just laying out what the options are, what the risks are, and then the client's making an informed decision. So that's really where it sits. Now, the other thing with that is there's changes to the tax TPB about, if someone is being a bit pushing the envelope and a bit of a cowboy in some of these things, then, the tax practitioners, that sort of stuff has to be reported through. So that's a new change coming through from 1 July 25 that everyone needs to be aware of. So it's becoming a lot narrower for people to push the envelope on certain things from that perspective, but it's just an awareness. Because if you weren't aware of a sole purpose test applying and all of these things because you're relying on your advisors, then, the advisor needs to be on top of all those things. And if they're not themselves, then that's where there's specialists around that can assist.
Yeah, you're absolutely right. It's not just the window of practice that's kind of narrowing for advisors right now. And, there's a whole myriad of stuff. You mentioned that it's almost, what do they refer to that as, the Dobbin
The
provision
Dobbin, yeah,
for the Tax Practitioners Board.
yep.
And of course, again, you prudently highlighted that there's professional indemnity insurance issues here of whether or not your practice will be covered by some of this stuff. But I think the one thing that's really important for advisors to understand and this is almost like a basic human character trait, if you want to call it that. When trustees get in trouble, not just trustees, but a lot of people, it's human nature not to own up to your
Yeah.
mistake, right? It is. That's just
Whose fault is it?
human
It's not
nature.
mine. It's
Correct.
someone else's fault.
So it'll be like, oh, the ATO's going me on this. I thought I was all right, but now I'm in compliance trouble here, and I could be facing a serious liability if they impose penalties. It's got to be your fault, Gemma.
Yeah. Isn't it your fault, Gemma?
It
Yep,
can't
that's right.
possibly be my fault, even though another important point to come out of this is that the ATO always says no matter what happens, the onus is on the trustee to take responsibility of what
Yep.
they've done. Even if they're the most egregious circumstances, like the instance where the drug addict's son siphoned all of the money
The
out of the
money. Yep.
superannuation, and basically the entity was just left as a shell without being able to operate. And the parents pleaded their case to say that, hey, look, we didn't know any of this was happening. The regulator did show some sympathy towards them, but basically said, hey, look, at the end of the day, responsibility's on you.
Yeah.
Now, that is true, but they're not going to sit that. Not going to lie down and take that. If they can apportion blame, they will.
They
And
will,
practitioners,
absolutely.
no
Yep.
matter how solid your relationship is, they need to understand that as a character trait of human nature, they're not going to stick their hands up and say, that was my fault. And
Yep.
I'm happy to wear this. And I mean, we're seeing it on so many levels. I know it hasn't played out yet, but that whole, and I'm going off piste again
Yeah.
here,
Again,
but
that's
that,
okay.
but that whole issue with wholesale investor,
Yeah. Yep.
retail investor, that will be exactly the same. And in fact, how did it come about? Is because the guy lost money, and
Wanted to
I'm
lay
sure
some
it wouldn't
blame.
have been an issue if he'd made money because he was treated as a wholesale investor. The fact that he was treated as a wholesale investor and lost money started the wheels in motion for, right, well, it couldn't be my fault.
Yeah. And
It's
that was
got, it's
one,
got to
and
be
again, we're
somebody
off
else's.
piste here. But that was where there was, it was, you would use the term contributory negligence, sort of, which was that they had contributed, the investor themselves had contributed to it. It wasn't just in the lap of the advisor. And you can kind of see a little bit of that happening now as well with like this case again highlights it. So, and it's probably, a segue onto the lead into the next episode, where we talk about the disqualification element, because the fact that Gordon had had advice helped on that front. And so there seems to be a bit of an angle on the accountability coming through for the advisor. It's not just firmly in the lap of the taxpayer, because if you read many cases in recent times, it's all been about, well, you're the taxpayer. Yes, you had advice, but too bad, too sad. You're the taxpayer. You take ultimate responsibility. Now that is shifting, and you can see it here in the next bit, when we talk about it next time, is looking at, well, there was an advisor there. They had taken advice, and therefore it isn't squarely on the taxpayer.
Yeah, it's definitely a consideration practitioners need to take into account.
Yep.
And if you have a look at some of the unrelated court decisions that have come down in recent times, I think, was it the Baumgartner case where it was taken to court and the auditors were actually held
Yes.
liable
Yeah.
for the losses, even though I think it was a distinctly probably unfair decision on the
Well,
auditors.
that was both, like there was two of them where the auditors were the ones who were left behind that had PI cover, and they
Well,
hadn't asked enough questions about the recoverability of a loan, and so they were held liable. So, again, that who's to blame, who's got some pockets that have got some money
well,
in them, and let's
and
let's let's go for it.
And of course, Gemma, that's probably one of the most worrying things. And I know we don't talk about it very much, but it was actually noted that they went after the professionals because they had professional indemnity
Indemnity
insurance
cover.
to cover them. Now,
Yep.
that's not the reason for taking out professional indemnity insurance. Obviously, one of the things is you can't operate without it because that's a condition of your license. But that's not what it's designed for.
No.
It's not. It's probably not a correct application of what the safety net's for. If I say to you, well, actually, Gemma, I'm going to find against you because guess what? Uh, Darren's out of money, and you know it's a little bit unfair on him. You can make a PI claim on this. So guess
Yeah.
what? It's on you. So
It's
he
on
can
you.
get
That's
some of his
right.
money back
Yep.
and everybody's happy. It's not the way it's
Except for
supposed.
Baumgartner.
Yeah,
Wouldn't be
exactly.
particularly happy.
Exactly.
And the PI insurer,
Yeah,
yeah,
it's not
all
the
that
way
sort
it's
of stuff.
supposed to work. And
No.
and I actually found that quite worrying that it's no
That was
disguise.
the outcome. Yeah.
Yeah, exactly. Everybody recognizes that was it. So, if you're being attacked from both sides, like maybe the court will interpret a decision like that. I don't know. But you can definitely be assured that the individual involved will not just stick their hands up and say, mea culpa.
Yeah.
Yeah, it's on me. I'll wear the liability.
Yeah,
No way.
totally.
They will be
Totally.
like, but hang on, I had this conversation with Gemma. Right. That's it. It's
Gemma's
her
fault.
fault.
It's
Or
Gemma's
even if it's
fault.
not entirely her fault, it's got to be partly her fault. So
Yeah.
I'm going to go after her and let her wear some of the blame for this because I'm not I'm not taking all of this on my shoulders. That's a fact. We
Yeah.
know that's a fact. We've seen it
Yeah.
happen.
So that's probably a good segue into listen to the next episode where we talk about that in a bit more detail because I think we've run out of time as per normal and we've
Yes,
gone
we
over
have.
our allotted time. But yeah, really interesting to unpack this one and take the opportunity to unpack it as well as we can rather than being just doing all four of the issues here in one episode. So yeah, but as per normal, loving to have a bit of a nerdy chat about it.
And as we've discussed, you can't use the Bart Simpson excuse about I didn't do it. Nobody saw me do it.
Yeah.
You can't prove anything. No,
Yeah.
that's not going
No,
to wash it. So
not gonna wash,
I got
not
them
gonna
both
wash.
in. I got the Star
You
Wars thing.
did. You nailed it. You
Yeah,
nailed it.
so tick those two boxes as well.
Yeah. Perfect.
But we won't go on for much longer. We've obviously got two more pieces of this case to unpack in the next episode. So looking forward to that. And again, heaps of implications for SMSS if there weren't enough that we discussed today already.
Yeah. Yep.
So look, thanks as usual for your time, Gemma. Very much appreciated and loved having the discussion.
Yep. It was awesome. Thanks, Darren.
Thanks to my production team for putting this together. I can't do it without you, so very much appreciated. Don't forget, if you're enjoying our content on YouTube, please hit the like button and subscribe to the channel. Thanks for joining us. We hope you've enjoyed this session as much as we enjoyed bringing it to you, and we do hope that obviously you got some useful information to be drawn from the merchant case as we just discussed. Other than that, have a great day, and we look forward to seeing you next time for the Cross Country Super Podcast. Bye for now.
Bye.